you on the map. This is Ron Costa broadcasting live from the Mappable USA studios in Las Vegas, Nevada. And today, folks, we're going to talk about some Reg.A differences between Reg.A, Reg.D, etc., how that pertains to real estate, maybe get into a couple other topics. And in order to do so, let's introduce Vicky Hutchmala from the World Token Market. Vicky, how are you today?
I'm fabulous today, Ron. Another perfect day in Vegas. We're so fortunate to live here until it gets to be 120, and then we just complain until it, kind of cools down a little. But today we have one of our favorite guests, and even though I say that every time that our guest is one of our favorite guests, our guest today is so impressive and so, I just love having him on. So let's just not waste any more time talking about the weather and get right to it.
Not after a lead-up like that. Oh, my God. I'm all caffeined up like we talked about before the podcast, so let's get this thing going. Folks, let's introduce Ryan Garland from Paradigm Investments. Ryan, how are you doing today?
Hey, great, guys. Thank you so very much for adding me to this, and it's always an honor to be a part of your guys' podcast. It's probably my favorite thing to do during the middle of the week.
Oh, thank you.
Thank you guys very much.
Absolutely. That's great. I hope, Ryan, that you have a coffee in front of you as well, because we're really we're hyped up to do this podcast today for sure.
Absolutely. Yeah, I'm ready to go. I've been looking forward to it all morning.
So as Vicky mentioned, you've been on our podcast before, but maybe people haven't heard the previous ones. Really quickly, can we get a little bit of a background on you and maybe something about Paradigm?
Yeah, no problem. So so Paradigm's located here in Temecula, Southern California. We're about 45 minutes north of San Diego. Most people correlate Temecula as wine country, which it is. And so it's a great atmosphere, a lot of family, a very family-oriented environment. Hence, this is more of a family office. And so we basically specialize in raising capital for debt and equity projects. So, for example, if we have a guy or investors that are looking for passive income, we have a vehicle for people to invest into and get some passive income and get dividends throughout the year. And then we also have other projects that are, a little larger commercial real estate transactions, ground-up construction, multifamily, workout turnarounds, just kind of almost in many, many different asset classes. But we will provide debt and equity for those projects, so people who are looking for a little bit larger return and aren't necessarily looking for income, but to build a little more wealth. And that's what we do. So we work with a lot of small investors, large investors. We have a crowdfunding platform, and we have a large back office, and we provide a lot of support, a lot of wealth management as well to our clients. And so we're in the game of building relationships and making people wealthy.
You had me at Temecula.
Relationships where it's at.
Yep.
Yeah,
I'm telling you, if there was,
where it's at, right?
Exactly. So let's get into this whole thing about Regulation A and why some companies go Regulation A, why sometimes you do a Reg.D offering. What do you think is the main differences between a Reg.A and a Reg.D or something along those lines?
Sure. So really, a Reg.A is a so back in 2013, the Jobs Act, there was a kind of some new legislation that released some compliance, loosened compliance to allow fund managers or for startups to go out and raise capital for smaller investors, people who aren't necessarily the wealthiest, people who are making less than $200,000 a year or may have less than $1 million in net worth, called a non-accredited investor. And it allows those particular, we would call mom and pop, want to get into investments to get to participate in some sort of startup or, in this case, real estate transactions, and basically benefit from the returns that even the wealthy people would participate in investments, to basically stay in that same boat and get the same type of investment. So that's what a Reg.A was set up for, and the Reg.D is a private placement where a fund manager like myself would go out to specific people, typically friends and family or maybe higher net worth investors, and raise capital, and they would be accredited. So people that are making a little bit more than $200,000 or more a year, or have $1 million in net worth or greater, and they would participate in our real estate transactions. So really the difference between Reg.A and Reg.D is where people that aren't making as much money can still participate in investments, where a Reg.D, you have to have high net worth.
Okay.
So are very many of your projects, do you use this type of crowdfunding, capital raising in many of your projects or developments?
Yeah, for the most part, we do both. So whether it's through a Reg.D or even a Reg.A, we absolutely use our crowdfunding platform to raise the money for all of our projects.
Oh.
When people talk about a Reg.D, is it the same as what they call 506C or B or whatever? Is that interchangeable?
Yeah, so the 506C and B are both Reg.D offerings, yes.
Okay, so what makes one of those more attractive than the other?
Between the 506 or the
yes.
Reg.A?
Yeah. This is the 506 now. Yeah, the 506C versus B.
Sure. The 506B is really for kind of friends and family, people that you know that you want to go out to and raise capital. So again, it's more the friends and family. The 506C is really a softening of guidelines to allow you to solicit to raise capital for accredited investors. So that's really just the difference between a Reg.D or a 506B and a 506C Reg.D.
Yeah, and a lot of people say one of the big advantages of a Reg.D offering is that you're not capped on how much you can raise, whereas the Reg.A you are capped. Is that right?
That is true. Yeah. So the Reg.A, there's two different tiers. There's a tier 1 and a tier 2. A tier 1 is only up to, so that for the Reg.As you only can go up to 20 million for a Reg.A tier 1, and then the tier 2 is up to 50 million. But there is an expansion. You can go up to 75 million for tier 2. But that's a little bit different. You actually have to grow through the SEC for you to pass comments through the SEC, meaning they have to basically accept your business model for you to be able to get up to the 50 million or to the 75 million. But you are correct. A 506C or a 506 Reg.D, you can make it $1 billion fund if you want to.
Yeah. And if you're going to do a Regulation A offering, it's not a cheap endeavor for sure. People think it might be cheap, but they want to kind of do it on a shoestring, but you just can't do it that way. I would think that if you're going to do a Reg A offering, you would just go tier 2 anyway and not tier 1 because, why not? It's going to give you a broader audience towards accessing capital markets. And I think that's what a lot of companies look at, right?
Yeah, I think what it comes down to is what's your business plan and how much you're trying to raise. I mean, depending on what you're trying to do, if you only need 10 or 15 million, then you don't necessarily need to do a tier 2. You could do a tier 1. But a tier 2, if you are looking to be, a lot larger, raise a lot more than 20 million, then yeah, you'd want to go with the tier 2. But you nailed it. It is definitely much more costly and much more time consuming. That's why I think a lot of people don't go down that road. For us, without going into the cost of it, it took us 3 years for us to pass comments. And one of the main reasons was because of the pandemic. The pandemic put things on hold for over a year. But yeah, it can be. So if you have a 506 Reg.D, you can basically prep, almost overnight if you really wanted to. They're template based. I say it humbly and respectfully. And depending on how much strategy you're implementing and how big you're trying to go, whether you're trying to be more institutionalized or deal with smaller investors, there's all kinds of everyone kind of has their, I guess, way of thinking about preparing the Reg.Ds, but you can get a Reg.D prepared in a week and go into market. Where a Reg.A, a tier 2, you have to go through the SEC, and there's a lot of prep involved. You got to get an audit done. Depending on where you go, you have to go get aligned with a broker dealer or some RIA, and kind of go through that. So it's a much more complicated offering.
Yeah, and then there's the Reg CF vehicle as well, right? Are people using that to raise money?
Yeah, so people are still using that as well to raise money. We haven't necessarily needed to go down that road just because of the nature of our business plan, but you can absolutely use that to go down and raise capital, even through a crowdfunding platform as well.
Yeah, I believe the Reg CF was capped at $1 million at one point, but now it's up to $5 million, I think.
Yeah, that's correct.
Yeah. Okay. Interesting. So a company so like real estate guys like yourself would probably never use the Reg CF because it's just not enough money for major developments, right?
Well, yeah, I mean, like I said, it really just comes down to your business plan. Some of our plans, some of our projects, we're only raising a couple $1 million for. We don't necessarily have to do the larger transactions.
Oh, okay.
But the reason why we went, so it really just depends on kind of how you're set, and then also kind of your strategy. Like you really have to, what it comes down to is understanding your network. So me as a fund manager, understanding my network. Do I have a lot of larger check writers in my network, or do I have a lot smaller investors? And then also, what's my business plan? Do I want to manage several different assets, or am I really looking to just do one at a time, right? Just one-offs. And so for us, we do have the support and back office to do volume. So having a Reg.A tier 2 where we can do, 15, 20 projects as an example into one portfolio, that makes more sense for us, where some other people are rather just do what we call an SPV, a special purpose vehicle for individual deals. And then they feel that their investors would want to just participate in that one, where for us, we know that our investors are looking for the diversification. So they can go into a portfolio that in some cases the diversification into a lot of investors correlates to security, where they can put their money in one, but even though it's into the portfolio, it's spread out over across many different projects. Therefore, they feel more comfortable to get involved. So ultimately, it really comes down to what does that individual fund manager feel their network is good for. So it really has to do with strategy.
Well, the thing above that, though, is all the different opportunities that you have to invest in deals such as this, there have to be offering documents in all of this, right? Reg.D, Reg.A, et cetera. Whether you call it a PPM or what have you, is the documentation different for these kind of deals? The overall offering?
Yeah, definitely. So, and it really because of the what reg you're using, absolutely. But the risk disclosures are kind of the same, and there are different compliance attributes to each one as far as which offering you're going with. But for the most part, they're all the same. Look, the bottom line is that you really want to be very transparent with your investors and say, listen, you guys are putting your big boy pants on. Here's our business plan. You know what you're getting yourselves into. There is risk involved, but we want you to feel comfortable on who you're getting aligned with. And really that's what our biggest thing is, right? We use a platform where investors can log in and take a look at any given time at what their investment portfolio looks like. So like the CrowdStreet model or the Realty Mogul model where you can log in, have your own portfolio and your own profile, we have the same thing. So it creates a lot of transparency. It also provides a level of compliance that some of the investors don't necessarily know. But it really comes down to is for us is making sure that these investors know what they're getting themselves into. So the disclosures on each set of these documents are really the most important. And then inside those documents, you want to be very specific on what your business plan is, what your target is. If you're going to go after, for example, multifamily, that's your target market, then that's what you need to disclose inside those documents, right? And how you're going to go about it. What's your loan to value going to be? What's your workout turnaround going to be? What's your backup plan? What is your return to the investors, your projections? All of those things really need to be implemented into those PPMs or those documents, so that way the investors have a very clear picture of what they're getting themselves into. That's what it all comes down to.
So whether you're going to use a Reg.A or a Reg.D or a Reg.CF, whatever vehicle you're going to use, there's still a lot of preparation before you do your actual launch. And when you say it could take a week or it could take 6 months or whatever, does Paradigm offer the expertise, the professional people to help you to put together the documentation that you need, to help you with the marketing that you need beforehand, so that when you actually launch your crowdfunding vehicle, you're on the way to success because you've done all of the work beforehand, and Paradigm helps your investors to do all of those aspects?
So in my opinion, you nailed it, right? That really is kind of the secret sauce. Really kind of building your foundation deep and wide is the most important. So to answer your question, yes, we do go out. So my securities attorney, so, for me, I kind of have a different perspective. I think a lot of firms, once they get to a certain point in their career and how they're really trying to go out to market, they realized that having, sometimes writing a bigger check for the right attorneys is very important. And what you actually get for writing that larger check, once you've written that check, you'll understand why when you spend the energy and the time going through strategy, going through your marketing, and getting to know and understand the compliance side even more, it's priceless. It really is. For example, for us, when the pandemic hit, and basically into February, March of last year, I think all of us were like, immediately thought of 2008, especially you guys in Las Vegas, right? 2008, here we go. It's all coming down the road. And so my background, my pedigree was in fix and flip financing. That's kind of how we ended up, starting adding zeros behind our projects and getting into commercial and wanting to provide different security measures for our investors. But when this all happened, what I did was I said, look, I'm going to go back to my roots and I'm going to open up a debt fund. And because you have all of these, with all the job losses and all these people having 401ks and IRAs coming available, we knew that people needed to park their money somewhere and possibly offset their income and try to generate some cash flow, but not burn through, if you will, their savings, right? So going into it, and then watching what was going on in the banking industry and the traditional mortgage space and lending parameters buttoning up, we also looked at, you have cities that still have mandates to build homes and build, we already know that homes are, we need homes across every city and every county across America. I mean, we are just short homes. So we looked at it and given, let's say, for example, what was going on through the elections, we wanted to have a very conservative approach going, okay, let's say which person wins the election, no matter who wins an election, what's going to be a safe investment no matter what, even given the pandemic. So going into strategy and structure was very, very, very important moving forward, in my opinion, more than ever due to those two situations. We've never had a pandemic. We have people losing jobs. We have all this. It's really scary, let's be honest, right? We can probably talk until we're blue in the face about it.
Absolutely.
When we had our attorneys, we all sit down and go, okay, this is what matters. Our investors, we need to protect them. And what can we do? So let's look at all the worst case scenarios and create a bubble around them and go out to market. So when I engaged with my law firm in March, I didn't launch my fund until December. So we constantly went through, we brought in an in-house data scientist and we went through data after data and tried to forecast what our plan would be. And right now we feel that we made the right decision and it's really taken off. And even if the market were to get really bad, even that strategy with our fund will become sustainable. We can sustain the company, we can sustain our investors, and we've created the back office and other ancillary vehicles to kind of isolate that fund and protect our investors. So more than ever, having the right attorneys, going into the right strategy, understanding your market and understanding your marketing and compliance is absolutely key when creating a fund and going to raise money.
Right. And, I don't care what industry you're in. Every industry has its own language. And just because you want to invest in something, whether it's real estate or anything else, you don't always know the language of the industry. And that's why another reason why you need experts and professionals, because they understand the language and can help you get through it that you otherwise wouldn't be able to do.
Absolutely.
It's another important aspect. And strategy. Yeah. You have, just like you said, if this is going to happen, then there's always something opposite that might happen. And as long as you understand this may happen, and so here's the effect, or that may happen, and here's the effect, and you can look into the ripples of each one of those situations or scenarios, then you're ahead of the game because you've already anticipated and you already understand what might happen, so you're ready to go. It's not a surprise. It's not going to hit you between the eyes because you already anticipated.
Yeah, exactly. And, that saying, if you're the smartest person in the room, you're in the wrong room.
Right.
Exactly.
Our advisory board, is pretty aggressive. I mean, I think almost every person on that board, they're in the business a little differently than I am, but their track record is massive. I mean, bigger than mine. And so I really, really focused on bringing in the right voices to kind of all collectively come together and go, okay, combined years of experience going into this market. Several of them have been through several downturns due to their age and length of being in the business. So their mindsets are different, and it's great to have that pedigree connected to the company. So really what
Absolutely.
It comes down to is just being open-minded, understanding, and really listening to what, 2 ears and 1 mouth, listening to what the market's doing and listening to what other people are fearful of, and just build a business plan that'll create, sustainable investments for people and be in the business for a long period of time. Our book of business, where our value is not the investors that invest the first time. It's the time when they invest the second, the third, and stick with
Absolutely.
us for 10, 15, 20 years. That's really what makes a firm like ours valuable. Over time, you start building, you have $500 million, $1 billion under management, and just kind of continues to elevate. And then when you sit back and let's say, for example, you're in my chair, you get to sit back and you get to see all these investors, and they're providing for their families and their grandkids, and you kind of get to, you're in essence establishing relationships with all of these people. It's a pretty good feeling knowing that you're providing some security for them,
Oh, yeah, because you've changed people's lives for the better, and there's nothing more special than that. And it's not, being like a conceited type of feeling. It's just a satisfaction that you get in your ability to help people to become better. And that's, what more can you want than that? Is that
exactly.
why, every CEO of every company thinks their company is better than everyone else's. And so I want to ask you, what is it that makes Paradigm so different? Aside of what we just said, what's that key thing that makes Paradigm different, and why everyone should go to you instead of anybody else?
That's a good question, and I think all the way up to, I know this sounds really funny, I think all the way up until about a year ago, I kind of figured it out. I always felt that maybe the way we established relationships was really what kind of stood us out, maybe due to the value, the way that we did volume and kind of our existing network was maybe what made us stand out. But I'm kind of coming to the conclusion that I think what makes us different is I didn't come from, a wealthy family. I came from a single father in law enforcement that raised me, and I really didn't have a lot of the support to get to where we are today. I really had to figure it out. And I think, first of all, the Lord had a big play in that, but two, the reality is that I had a lot of opportunities that opened. And the reason why those opportunities exist was because I really cared about the relationships that I was establishing. All the way to like my ex-girlfriends and my ex-wife even, I still have a great relationship with everybody. So I've been able to, I think, continue to eat, breathe, and sleep relationships. And that I think a lot of people have just given me so much love and respect that I've kind of earned my way up and have aligned myself with the right people. So I can humbly say that I didn't come from, I didn't get a finance degree from Berkeley or USC. I really kind of earned my way up, and being boots on the ground, I think, is what's given us the leg up, because I can look at a construction budget. I've built homes. I've split properties. I can look at a construction budget. I have the intuition when I'm talking to somebody if they're lying to me. I can kind of go through that, and I think that gives us the leg up that most firms don't have. And I think that's really what makes us different. Yeah.
Yeah, I'll tell you, Ryan.
Get you where you're going.
Ryan, if you have a good relationship with your ex-wife and your ex-girlfriend, we got to do a whole podcast on that alone. That's amazing.
That right there was a whole nother level of keeping the.
How do you do that one? We'll do a 5-hour podcast on that one.
Yeah, that's great. Yeah, what's cool is my wife and I actually are actually in several podcasts now talking about, even because my wife works with me now. She runs, kind of the back office, and so we kind of have a unique business here, but it's really kind of cool. So we actually have that going out. How you can have 3 kids and stay married and work together and keep those balls in the air, that's also unique as well. So relationships is absolutely key, and just like Tony Robbins said, real wealth is in the relationships in which you establish.
Yep,
absolutely.
exactly.
That's profound, and that's absolutely correct. It's the relationships that not only that you create, but more importantly, the relationships that you can maintain over a period of years, including the difficulties, including the good times, and still let that relationship grow into something better. That's key. That absolutely is key, and that would set you apart, Ryan.
Oh, absolutely.
Yep.
I have some very, very close people with me Danny Parks has been with me for 17 years. She's been next to me. She's been, she's on my board. And so I trust me, I am with you 100%. I couldn't agree more. Relationships is really key. And I'd have to say that that's probably our number one component to the growth of our company. People continue to believe in us and think that we're making great decisions, and we've sustained 2008, we've sustained the pandemic, and we continue to look at things from a conservative standpoint, and I think that's just really the best way to play it.
Yeah, exactly.
Yeah.
You know what? I have just a couple more
that,
questions before we close out this podcast. One is, we talked about before the preparation, and we really didn't touch too much on the marketing aspect of the differences between these Reg.Ds and Regulation A. Can you kind of just touch upon that really quickly, is maybe from social media implications and things like that, or what you can do, what you can't do between the two of them?
Yeah, you bet. So number one, it's always about disclosures, having the right disclosures and making sure your target marketing is on point. Social media marketing is, to be honest with you, it's kind of a free-for-all. It's like throw stuff up there and it goes out. But the reality is you got to be compliant. So with the Reg.A offering, because it's non-accredited, you really just have to the marketing for that is really kind of an open market. You can just stick it, put on a billboard and go kind of crazy, if you will. But so what we've done and through crowdfunding is really kind of the pedigree for social media and going broad on marketing. So we're on every outlet you can imagine, which is not cheap. So for example, if to do it right, getting the right PR, the right Google, outlets, YouTube, video, doing all your video editing, it's just, there's a lot to it. So crowdfunding is a beast in itself, but the reason why we went down that road was because I already had a network on Facebook that was really kind of creating the revenue we already had. So we knew the fastest way to kind of launch was through our existing network. So having that big social media following was pretty big. Now, the other thing is, and I'm going to touch on this and I'll go kind of in answering that question a little deeper. One of the biggest things right now, and it's kind of a funny thing, but it's so serious. You can look at, Gary V, and you look at all these other people on social media. They are truly the influencers of our time. And influence marketing is really where it's at. So if you have a lifestyle brand like you have Grant Cardone, now I have a different perspective on how he rocks, but he's doing it. But when you have like the Grant Cardone, that he pushes a lifestyle, and that's where the world's kind of going. If you look at the data, lifestyle is where it's at. If you look at boats and RVs and cars and planes and all the sales that just went on through the pandemic, it's all about lifestyle. So that we can kind of tailor our marketing to kind of a hybrid between, investing in real estate, having a very secure institutional grade investments. But what's attracting a lot of the investors to engage is that we are family people. We like to go to the river. We like to go to the beach, and everybody inside our company has that family oriented environment, but we all have, a normal life. And so we post that, right? So we're very transparent to the world, but that works. The difference between the Reg.D offerings and private placement for accredited and then the non-accredited is definitely a little different, because you want to target more high net worth for the Reg.D offerings, because again, you have to have accredited investors. So that is a different set of disclosures and a little bit different target market. Most of that is more like LinkedIn, which is a really good target market. As far as social media, everything else, and Facebook too. I mean, Fisher Investments is marketing for, retirement planning up to, 500,000, and they're getting a lot of investors off of Facebook for that. So so Facebook and LinkedIn would be our target market for the 506Cs and the Reg.D offerings. And then really it's kind of a free for all for the Reg.A. Hope that answers your question.
Yeah, it does. And the reason why I ask is because that's a great point. You have to really market to people who kind of feel a connection to you, and that's really key.
Right.
There's nothing that I hate worse than watching a YouTube video that I'm really interested in, and all of a sudden, at like 3 minutes into it, it goes right into a commercial or an ad that says, invest in our company. It's like you just ruined my YouTube experience with this video. I'm not going to invest in your company.
Totally.
Sorry. Right?
Yeah, totally. Yeah, totally. Yeah, I totally get that. We don't do as much as we would like on YouTube. We know it's very valuable, but it's just that's not really our brand. Getting up there and kind of showing cash money and that's not really our thing. We get it. We know that there's a hook to that, but that's also not really. If you were to come into my office and you see, for example, my ops manager has 2 master's degrees. My president's the former mayor of Marietta. We have also very, very, very professional, extremely professionals in our company. And so the reality is we still need to be very entrenched into understanding what we're getting ourselves into. So we don't want to be like one person on social media and be completely different behind the scenes. That's not really what we want. We want everybody to kind of get to know us for who we really are, but know that we're just normal people and we like to enjoy our lives as well. That's kind of what our branding is.
And you do a great job at that for sure. We're both lucky to both live in cities that people vacation to. So that's a great thing. But I have one more question for you. A lot of people talk about real estate investment trusts, these REITs and things like that as a vehicle. Do you guys do any work in that, or how does that differ from what we were talking about earlier in the podcast?
Yeah, absolutely. So in fact, our 506C Reg.D offering for our debt fund, which is our income fund, that is actually set up for me to elect to a REIT if I decide to. There's a huge positive to that because you're only going to get taxed at 80 cents on the dollar as far as the investor's income. So there's a possibility that at some point I decide to elect to a REIT, but we are seeing that as being very positive. And the reason for that is because not only would the returns go up for our investors, again, because of their tax abilities as far as they're going to retain more of their income when we pay them out their dividends. But you're seeing that people have that they're fearing what's going to happen with inflation and the cost of living and all of these things are going up. So being able to elect to a REIT at this time would be very smart to boost our investors' returns if something were to happen. So that is absolutely a great strategy as far as some of the data that we're seeing. People are wanting to get into REITs, again, because if you are producing dividends yearly, quarterly, or monthly, you really can go into offering REITs to investors, and they're diving into them, especially with the returns that we're providing. So I think ultimately anyone who's looking at managing a REIT and offering that for people for income, absolutely, it's a good direction.
Excellent. Okay, I one more question. Are you seeing anybody using the SPAC vehicle to raise money for real estate projects? I know 2020, there's been a lot of money put into that. People are talking about it in 2021 as well.
Yeah, absolutely. Yeah, SPACs. Now, I don't know enough about SPACs to really be able to talk high level on it, but I do know that it's a big movement. I think a larger movement is DSTs. DSTs are really, really big because you have all these people that have, capital gains in 1031, and everyone's fearful about what's going on with capital gains. And then right now, because inventory is so low for housing and apartments, people who have, 200, 300, 500,000 even can't 1031 exchange into another property and also don't want to manage the rental, but even find a property to invest into. So you have this huge demand of people who have 1031 that are trying to place their money, but they just can't find a spot to place it. And so you're seeing this nervousness between those investors. And so DSTs, I think, are probably one of the biggest movements for the next 2 years.
What does DST stand for?
Delaware Statutory Trust.
Okay. Yeah, cool. That's really interesting. Yeah. I know a lot of people who are going through the 1031 and going through exactly the issue that you just faced. They can't find the property that they want to roll into. So that's a really good option for them. Hopefully they'll listen to this podcast, So, this has really been very interesting.
Yeah, DST is a big movement right now. REITs, yeah. Anything right now, if you just think about it, the world's scared of what's going to happen with taxes, capital gains, and inflation. So to be able to provide vehicles for people to get into, and then we have the network of developers and builders and so on and so forth, we now have both the A and C process. We're the B, right? So we have the developers that we obviously need assets we can put the capital out on. And then we have the investors, and then we're the B. We're the compliance. We're the ones that manage the funds. We're overwatching the projects, making sure we're holding the developers and builders accountable. We're watching over the lending and so on and so forth. So, that's kind of really the marriage between A, B, and C.
Interesting. And then one last topic before we close this out. What do you know about ESGs? Are you familiar with those?
Yeah, absolutely. Yeah, we are a big believer in ESG. We're very environmental friendly. Obviously being in California, every new builder, new home has to have, solar. We also understand CPACE and having good, healthy green building material. And also the health and wellness component is massive for us too, because we understand that, office space and homes are going to change due to the pandemic. Everyone's going to be very, cautious of another pandemic coming down the road. So we're very forward thinking on hospital grade air, circadian rhythm lighting, again, filtration systems in these areas. So when it comes to ESG overall, we're very, very involved in that space as well.
Okay, well then, I'm sure anyone who's interested in real estate listening to this podcast right now is going to want to contact you after this podcast for sure. So, Ryan, what's the best way to get a hold of you?
You know what?
Website,
probably,
email?
Go right to my website, Paradigm Investments. We spell Paradigm a little differently, PARADYME, investments.com. You can chime in, log in right there, or even, look me up, look up the CEO. You can find me all over the internet, send me an email, or send me or give me a call here at the office. My office line is 951-5304. And again, our website is paradigminvestments.com.
Excellent. So, Vicki, Reg.A, Reg.D, Tier 1, Tier 2, 506C, 506D, SPACs, REITs. Did we leave anything out?
We didn't leave anything else, except I will say this. Remember, Ron, we met Ryan at an Opportunity Zone Expo a couple of years ago, and I was so incredibly impressed with Ryan even before I talked to him, because the people around him were, devoted to him. They just had this, it just, shot out of their eyes, this deep respect and deep devotion to everything Ryan. And now after this podcast, and we see his approach to Paradigm and what's important to him, and how creating those relationships with a variety of people that incorporate morality and incorporate experience and the ability to relate to investors and to his team is what makes Ryan so impressive. And the person you need to talk to, the person you need to contact if you have any kind of project to do with real estate, Ryan's your person, because he absolutely is incredible. And that's all I have to say.
Wow.
Thank you very much.
Ryan, do you want me to just send you that snippet so you can add it to your LinkedIn profile?
Yes, I would. I would just put that in there. But there we go. I'd love it.
That was a great testimonial, Vicki. I'll tell you, that's great. But Ryan, listen again. I know you're really busy. Thanks for being on the show today. It's always a pleasure to have you on, and I know our audience always gets some great information from you. So thanks again for being a guest on the show today.
Yeah, absolutely, guys. Thank you so very much. Really appreciate it.
Yeah, and Vicki, thanks for co-hosting. Yeah, thanks for co-hosting the show today. It was really a lot of fun, very informative. And folks, you're listening to the Mappable USA podcast at MappableUSA.com. If you just go to that homepage and scroll down, you'll see all our syndication sources. You pick the one you like best, and you'll never miss another one of our episodes if you subscribe. Then, if you want to be a guest in the show like Ryan was today, there's a guest tab there. Fill that out. We'll see what you can do about getting you on the show. And if you like what you heard today, send us an email, info@MappableUSA.com, or just leave a message on whatever page you're listening to this on right now. So thanks, everyone, for listening. Thanks for your support. We'll see you next time on another Map Over USA episode. Have a great week, folks.